Alright, let's do a quick essential breakdown of today's major announcement from the Federal Reserve, because the initial move is not the whole story. The Fed just cut interest rates by a quarter point. That's the headline that flashed across every screen. But the real story, the one driving the market's reaction, is what came after. Fed Chair Powell isn't promising more cuts. He called it a mid-cycle adjustment, not the start of a long easing cycle. To understand the whiplash, let me set the context. The Fed's job, its dual mandate, is to keep prices stable and maximize employment. Essentially, a healthy economy with steady jobs. Lately, the data has been mixed. Inflation has cooled significantly from its painful peaks but is proving sticky in key areas like services. At the same time, economic growth has shown signs of slowing in a few key areas, like manufacturing and business investment. So, the Fed lowered rates as a form of insurance to give the economy some breathing room and guard against a sharper downturn. Here's the twist. Markets, which usually love rate cuts, sold off on the news. Why the negative reaction? Because investors had priced in the start of a steady, predictable cutting cycle. Instead, Powell emphasized that future moves are entirely data-dependent, a wait-and-see approach that injects uncertainty. So, what does this mean for your money? For mortgages, don't expect an overnight drop in rates. Mortgage rates track longer-term bonds, which are influenced by the Fed's long-term guidance. If future cuts look unlikely or one and done, expect only a modest drift down in mortgage rates, if any. For credit cards and home equity lines of credit, these are directly tied to short-term rates. You might see your APRs tick lower in a statement or two, but the savings will be minimal without more cuts. For auto loans and personal loans, some easing is possible, but lenders are still cautious and will price in the uncertainty. And for savings accounts and CDs, yields will likely step down as banks adjust to the new benchmark rate. If you're chasing high yields on your cash, now is the time to lock in rates on CDs, but always read the terms carefully. Now let's look at investments. For stocks, the initial drop reflects disappointed expectations. Without a clear path to more cuts, rate-sensitive stocks will wobble. Sector snapshot. Rate sensitives like homebuilders and REITs face headwinds. Financials, like banks, see their lending margins squeezed, and mega-cap tech, which benefited from low rates, could see more volatility. For bonds, short-term yields, which are most sensitive to Fed moves, will drop first. But long-term yields depend heavily on future inflation expectations. If inflation continues to cool, that's good for bonds. If it stays stubborn, volatility remains the name of the game. So, what's the playbook from here? First, know what to watch. Near-term watch, inflation prints from the CPI report, payrolls from the jobs report, and corporate earnings guidance. These will dictate the Fed's next move. For your portfolio, the playbook is about managing uncertainty. Stagger entries into new positions, manage duration on bonds to mitigate interest rate risk, and rebalance your overall risk exposure. The Fed is trying to execute a difficult maneuver, like tapping the brakes on a steep hill. Too light, and you keep rolling backward. Too hard, and you skid out of control. They cut to cushion a slowdown, but they don't want to reignite inflation. The key takeaway is this. The cut is here, but a clear path forward is not. The Fed's playbook is patience, and ours should be too. We'll track the data as it comes in. The market's path from here depends entirely on the trajectory of inflation and growth.